So charitable giving and tax planning. Well, let's look at this here. We have Albert and Shirley in the 24% tax bracket. They give $5,000 to charity. They have $15,000 of existing itemized deductions. They have a standard deduction of 20 in 2022 of 28.7. So the $5,000 donation really has no federal tax benefit because it doesn't add up higher than the 28.7 standard deduction that the two of them receive. So let me just take a look at this with you. If you're 70 and a half, let me just spend some time on this chart because this is really important. If you're 70 and a half and you are charitably inclined, the only way you should be giving money to that charity is via a QCD. A QCD stands for Qualified Charitable Distributions. Qualified Charitable Distributions. This is so important because it will save you money in taxes. You can do it up to $100,000 from an IRA per person. It must go directly to the charity. It counts as your RMD, but is not reported as income, and there's no deduction on your income taxes. So how does this look? Well, you can have two options on how to give to a charity. And let's just say you want to give $5,000 to a charity, whatever that might be. It could be your church, whatever it is. Charity gets the $5,000. The $5,000 satisfies the RMD. The $5,000 is reported as taxable income because what you did is you took the $5,000 from your IRA and you received it into your checking account, and then you wrote a $5,000 check from there to the charity. Okay. The tax bill on the distribution. Remember, I said that they were in the 24% bracket. So the taxes on the $5,000 is 24% or $1,200. So the total cost of this endeavor, this transaction right here, is $6,200. Now, there is a better way to do this. This is how folks have given forever. But remember, now you're 70 and a half. You also have this thing called required minimum distributions. You have forced income coming out at you. So there is an alternative, and that alternative is this. It's called a QCD. The charity still gets the $5,000. The $5,000 satisfies the RMD. Perfect. Check. The $5,000 is excluded from taxable income. Why? Because you never took possession of the money. You sent it directly to the charity. You see that I removed the checking account there in this chart? The tax bill on the distribution equals zero. You're not taxed on the $5,000. So the total cost of this charitable contribution was $5,000. You saved $1,200 in taxes, basically doing it via a QCD. And a QCD, many companies, many custodians now on their distribution form have a box that says QCD and the charity that it should go to. So, and for your tax return, now I'm not a CPA, but I've gone through this quite a bit with several CPAs. When you get the 1099 to show that you had your RMD successfully taken, it's going to look very similar to the 1099s you've always received. Where the QCD is picked up is on your 1040, and your accountant should know how to itemize that in such a manner that whatever the QCD amount is comprised of, it is exempt from your income taxes, okay? So just word to the wise, make sure that if you do a QCD, you check the proper form. The check has to go from the custodian directly to the charity. You cannot take possession of it, and that's a pretty strict rule with that. But, be that as it may, QCDs, great thing. All right, I hope to have assets to pass on to my family. How does retirement tax planning figure in? Well, it does in a big way. You want to organize your assets to your family's benefit. And in this regard, estate planning still matters. So let's take a look at this. And by the way, since I've been doing this tax planning strategy presentation for the last, I think I've been doing this one for the last 5 years, I've had this exact thing that I'm about to share with you happen now 3 times. 3 times this has happened. So step up in basis strategy. So the rule treats a beneficiary as if they purchased the inherited asset on the day it was left to them. Future gain or losses is based on the asset price of that day. So let's look at a couple, Phil and Mary. They hold taxable investments in a joint brokerage account, and that's the JTWROS stands for Joint Tenants with Rights of Survivorship. It's a way that you hold a brokerage account. The $120,000 of investments have long-term gains. Okay, so they've had them for more than a year and a day. And they would be entitled then to more favorable tax treatment as opposed to short-term capital gains, which is basically what your income taxable rate would be. That's what you'd pay. Unfortunately, Phil is diagnosed with a terminal illness and has 18 months to live. Now, I have to tell you, again, I've had this happen 3 times, and I'll just go through kind of the strategy here. Now, you can do nothing after the diagnosis, and many people do. But this is why you have this is why you have advisors, okay? Because I have annual meetings, if not 6-month meetings, with all of my clients, and obviously, health is something that I bring up proactively to see what's going on. So here we have a scenario where Phil dies and Mary inherits Phil's half of the joint account. The step up in basis eliminates the long-term gain on Phil's $60,000. If she sold all the investments, she'd only owe income tax on her gains. Her gains are the long-term gains on her $60,000 plus any gain on the remainder after Phil's death. The bottom line is that Mary owes tax on her $60,000 of gain plus any on the half after Phil's death. Now, I know this is not the first thing people think of, but this is, again, why you have help, why you have teammates, and that's called an advisor. Here's the alternative approach. After diagnosis, move all the assets into one account in Phil's name. Phil dies 18 months later. Mary inherits Phil's entire account of $120,000. Mary can sell and pay no taxes. So instead of getting a step up in only half of the account, she gets a step up in basis and saves all that appreciation in taxes on the entire account. And again, I've had this happen 3 times since I've been doing this presentation where no activity was taken. Now, I'll caution you, I use the 18-month period of time here purposely because if you do this maneuver, i.e. you change the brokerage account and put all the assets into the infirmed person's name, that infirmed person has to stay alive for 12 months. Okay, that's the rule. If they pass away in less than 12 months, then it's as if you never did the change. So the IRS got sensitive to this because there was a lot of deathbed movement of accounts into the dying person's name in order to get a step up. So now they changed the rules and that the person has to be alive at least 12 months. So anyway, again, this is something that you might want to think about. Talk to your CPA about it, and certainly your financial advisor. So when you go to sell your investments, in their case, would you rather owe tax on 60 of gain or 60,000 of gain, or no tax at all? Well, obviously, no tax at all.